Cyber insurance didn't become unstable because of wording, pricing, or exclusions. It became unstable because the wrong people were put in the wrong underwriting seats. We've watched carriers tighten forms, pull back capacity, and reprice after losses, and still get surprised. That tells me the problem isn't the product. It's who's making the decisions behind it. For a long time, cyber underwriting behaved like a series of isolated risks. One account at a time, one loss at a time. That world doesn't exist anymore. Cyber attacks today behave more like a catastrophe event. Losses are correlated, they move fast, and when they hit, they don't politely stay inside one insured's balance sheet. What actually determines cyber profitability right now isn't what's excluded in the policy. It's whether the underwriting team can see accumulation risk before it shows up on a loss run. And that's where most leadership teams are exposed, without realizing it. When cyber attack volatility shows up, the executive response is usually predictable. Policy language gets tighter, capacity gets pulled back, rates get pushed up after losses hit. Those moves are necessary, but they're not sufficient. Systemic risk doesn't announce itself at the account level. It shows up across a portfolio, shared vendors, common technology stacks, simultaneous business interruption across multiple insureds. If underwriters are trained to evaluate one account at a time, leadership is effectively flying blind at the portfolio level. That's not a market failure. That's a people problem. Here's the part most executives don't see until it's too late. A large percentage of cyber underwriters in the market were developed during periods of limited aggregation. Early cyber loss environments, heavy reliance on applications, controls, and checklists. On paper, they look experienced. In reality, that experience doesn't automatically translate to pricing-correlated cyber attacks, supply chain-driven losses, or multi-insured shutdown scenarios. The gap stays invisible, right up until losses cluster. And when that happens, everyone acts surprised. The underwriters who are actually protecting cyber portfolios today look different. They don't just assess individual risks. They think in systems. They understand how failures propagate across insureds. They challenge models, broker narratives, and internal growth pressure. They know when declining a risk is a strategic decision, not a missed opportunity. These underwriters are slower, more deliberate, often less popular internally. They're also the ones preserving capital when correlation shows up. This isn't about technical brilliance. It's about judgment under pressure. Where most carriers get this wrong is recruiting. Traditional cyber hiring still prioritizes years of experience, carrier brand names, and written premium volume. None of those reliably predict whether someone can manage systemic risk. Some of the strongest cyber underwriters in the market didn't come from pristine growth environments. They came from high-loss books, claims-adjacent roles, markets that experienced cyber attack shocks early. If your recruiting process doesn't test how underwriters think when things go wrong, you're hiring blind. From a leadership standpoint, there are 3 shifts that matter. First, redefine what senior cyber talent actually means. Experience without exposure to correlated loss isn't seniority, it's tenure. Second, screen for judgment, not just knowledge. Executive interviews should dig into how candidates reacted after major losses, where they pushed back internally, how they think about accumulation before it shows up in the data. Third, align incentives with portfolio protection. Compensation structures tied too tightly to growth quietly undermine cyber discipline. The underwriters you most need are rarely the ones writing the most premium. Here's the miscalculation seen often. Leadership assumes the cyber talent shortage is about availability. It's not. It's about calibration. There are plenty of cyber underwriters in the market. There are very few who can protect a book when correlation appears and pressure rises. Until hiring strategies align with that reality, cyber volatility will continue to surprise executive teams, despite all the right intentions. Cyber insurance won't stabilize through structure alone. It stabilizes when leadership builds underwriting teams capable of seeing interconnected failure before it becomes loss. The next phase of cyber profitability won't belong to the most aggressive carriers. It'll belong to the most disciplined ones, and the ones who hired for judgment early.